Good afternoon. Happy Cinco de Seis, which for some people is a sick day because they over-celebrated on Cinco de Mayo. I have to share, I had the privilege to celebrate Cinco de Mayo in Chicago with several hundred top real estate agents who are members of NARA, the National Association of Hispanic Real Estate Professionals. What a day we had, what good entertainment we had. I shared some facts, we had some fun, and we actually finished smarter. Speaking of finishing smarter, gosh, if you just watch the news, it seems like things are changing at a dramatic pace. Quick disclaimer. Last week we had some audio problems, and some people were missing audio. In fact, many people missing audio. So I've decided to upgrade my Winflation program by adding more material about gold, silver, diamonds, real estate, and food storage, and bring back some of the data because the data changed since last Friday tremendously. As you well know, or hopefully well know, the Fed raised rates again. They raised them in March. They raised them again. This time, 50 basis points versus the 25. That's the highest rate in one Fed meeting since 20 plus years ago. And I just was reading some material in the Wall Street Journal as I was getting ready for this, and some of the numbers are scary. Some people feel that Chairman Powell led people to believe that he doesn't want to have a 75-point increase, but it sounds like they're on a path by their language to be raising every 6 weeks when the Fed Open Market Committee meets. Remember, they meet every 6 weeks. So the next meeting is in mid-June. Then there's another one in late July. Then one happens in early September. But it looks like at this stage, unless something happens, they're planning on another 0.5% or another 50 basis points, which means for sure we will be at 1% change totally since March, even if they go 25 points. That 1%, as we will see, and I'll remind you again, changes the borrowing power for mortgage loans by a full 11%. That's a quick rule of thumb. Every 1% Fed increase, we see 11% change in the amount a person can borrow for the same monthly dollar amount. Got some other facts and figures that I think should pop up, but this would be the time. As soon as somebody can buy the money that they can and use it to make some good investments while they can. And I can't help but realize there's still a lot of money out there. I happen to be a person that collects credit cards. Some people collect stamps. Some people collect cars. Some people collect rare coins. I collect credit cards. And I use those as leverage because, well, you know, one of the ideal points of real estate is the leverage ability. But I just got this flyer for a reflect card, and I think you maybe can see some of the numbers. But this basic card is allowing people to borrow at 0% in a balance transfer for the highest I have ever seen, 21 months. I applied immediately, just got the credit card a few days ago. What does that mean? Let's pretend you had a $20,000 credit limit. Paying a 3% balance transfer fee, that's $600. That's your total cost for 21 months. That is amazingly low, and all you have to do is find any investment that does better than that for 21 months, or use it even in your real estate business to maybe upgrade some equipment, build a better web page, something that will create more wealth for you. That's the key. The money has to work, and this is extremely cheap money. At 21 months with only a 3% fee, we're talking about a net of about 1.5% interest rate before taxes. So you're borrowing money at a ridiculously low price at a time when prices are rising in price. So maybe this could be the best time you ever had to build wealth in Wayne's World and become a Wayniac by buying at least one income property in the next couple of months, but at least 2 a year. So the whole goal today is to reinforce, remind, and reflect on winning with inflation, because it should be a winflation. And in Wayne's World, we like to talk about that. With that said, everybody does different things. I use money, hopefully you use money to buy assets and make more money. But if I can borrow money and not use my own money to make more money, that even makes more sense, hence the power of leveraging, which real estate is one of the few that allows the majority of that. But a lot of people just buy money to buy things to make it look like they have money. And the bottom line, we're not the same people. Money talks, wealth whispers. It's nice to have nice things, but are you also having things that are growing in value, not just nice things? My friend just bought one of those GLA Mercedes little trucks, I'll call them mini trucks. Bought it for $180,000. He's already had offers for over $240,000. He bought an asset that's going to make him more money. He's not driving the car. I don't know what you're doing, but we're going to talk today about how will you win in inflation. And obviously you win by very simply realizing that this dollar bill is inflating. And obviously, if you have a policy of being too cautious, as you see on my quote to the left, that could be the greatest risk of all. Yes, risk equals reward. But doing nothing is a pretty big risk in a market like this. The opportunities have never been better to use money that you buy cheaply to buy hard assets that are growing. And again, as I say in the middle, check with your advisor, check with your investment objectives, understand there is risk in a lot of investments, and then get the tax and legal advice before making any investment decisions. I'm just, in my humble opinion, suggesting things that I feel comfortable with. I don't think I'm comfortable with them. I feel comfortable, and that's much more powerful. My thinking brain is not nearly as powerful as my feeling brain. So when I feel something, I want to pursue it. And you should do the same thing. Where are some of the best ways to invest, but still have the benefits of being somewhat safe in some ways? Because risk equals reward. With that said, we start to realize that the more you know about the past, the better you are prepared for the future. So please go back and do some reading. Just go on your phone periodically during breaks and read what's happening. We are now looking at, and the Fed seems to be reinforcing this, I think the second or third podcast I did this year, I suggested 5 to 8 increases I thought we'd have by middle of 2023. Chairman Powell, in yesterday's discussion that's been quoted in the Wall Street Journal, is basically saying, looks like 8's going to be it. What I didn't know, and I hope doesn't happen, is that he's looking at 0.5% jumps. We've rarely had 0.5%, 50 basis point jumps every time they meet in 6 weeks. But we know they're tightening. We know they're tightening because very simply, they just announced the biggest the biggest sell of their securities in the marketplace. All the pool, they're selling to take money out of the market. So there'll be some good, attractive interest rates to buy up some government securities because they want you to give them their money. That may be a strategy. And we will talk towards the end of today about a very good Fed product that is somewhat inflation proof, but reaps the benefits of inflation, called a TIP or TIPS, TIPS. Some of you know that. Some of you don't know that, but hopefully by the time we leave today, you will spend some time looking at that option as a less riskier way to still beat inflation. But the best ways we'll be talking about in a very few moments. But again, if you don't understand history, you are bound to repeat it. And I have never in my life seen the Fed have continuous 0.5% or 50 basis point rates. The last real problem we had back in 2004, they did raise rates 17 times every time they met, but it was pretty much 25 basis points all the time. This is accelerating it to get there faster. And we'll talk about the balloon that's blown up too fast and what can happen. And i.e., we call that possibly a recession. And here's my little reminder. Mortgage rates has staged the fastest, largest run-up in 28 years. And we went from 3.15 to over 5%. If what the Fed keeps saying is going to happen, we could see some buyers lose 22% of their buying power. If we get over 6%, that just means it's going to take more money to buy the same house for the same monthly allowance, or we have to borrow less money and buy a lesser property. Either way, we're still going to sell houses. Either way, listings are the name of the game. Either way, there's always buyers and sellers. We just have a little different kind of way we'll be negotiating. And I just did a seminar yesterday for the NARA people, and that was my topic, how to fear negotiaphobia, because my focus has been more than anything, agents buying 2 income properties a year. Hopefully that's you. Love to hear from you when you buy your 2 this year, if you haven't already. And learning the basics of solid collaborative negotiation skills. With that said, we have different kinds of inflation. We have the headline inflation, which is the one you see quoted all the time. And it looks at a lot of different items. You can go online and look at the entire market basket of the 70 plus items that are in the consumer price index that shows up as headline inflation. That is what you hear. That obviously doesn't affect as many of you as possible. I had to drive in from my home in Northbrook, Illinois, into Chicago, near McCormick Place, if that's a familiar location for many of you. That trip took me well over an hour and a half for 29 miles. I did that for the first time this year. Some people drive that every day. The extra gasoline they use just in idling and going 6 miles an hour and stopping and starting and stopping and starting, plus the stress, that cost of gasoline for that group of people is much different than the price of gasoline that I have to pay. It doesn't faze me if it goes up another 50 cents. I don't like it, but I don't need hundreds of gallons of gas every month. Some people have chosen to lower their temperature in their homes because of natural gas. Some people are finding different fruits and vegetables to buy because some are so expensive. Headline inflation is a number you see. It may not be the most accurate or best number for you to track what you're doing. So core inflation is probably a better indicator. Core inflation removes the biggies that cause fluctuations, energy and food products. Yet you're impacted by those, like the people driving to Chicago, the people with large families, the people who consume a lot of food in their diets. And so again, even though they're important, a good index says, how's the economy going? Because those change in price so much. Food and energy go up and down. Gas goes up 20 cents, gas goes down 20%, goes up 10, goes down 5, goes up. It just keeps calculating. So a better indicator of how the whole economy is doing is core inflation. But you never see too much of that because we use headlines, and headlines in some cases always want to show some negatives. They show the worst case scenario. And we'll talk in a few moments what's even better than you calculating or watching core inflation and headline inflation. Either way, we have too many dollars chasing too few goods. And every so often, some people look at things and see things, what happens. I just bought on Tuesday a half gallon of apple cider. On Wednesday, because in our area, the new price is going to affect on Wednesdays, the price doubled for the exact same bottle, exact same brand. Doubled in one day. Just an example. Maybe it's a glitch. Maybe it's going to be serious. We'll see what happens to that price next week and the week after. Will it continue to go up or will it start to come back down? But the key thing to core inflation is the products that have had the largest price changes in a short period of time are pulled out because they're kind of abnormalities in the system. So please, if you're really serious about looking at inflation, stay away from the headline inflation. Even though it might affect you more, look at the real core inflation for the entire economy. That can be valuable. And there's in the CPI these various categories, and there's about 75 plus items that are used in these categories that people buy on a regular basis. Just wanting you to start to look at something that really impacts what's going to happen to the mortgage buying power of the economy and how people are going to have to make some changes to win in inflation. Oops. How does inflation work? Different kinds. We're talking winflation, but there is demand pull inflation. People start buying stuff. We saw that when they started hoarding toilet paper when COVID began. And we still see some products that over certain periods of time become so expensive because everybody is buying all of it and there's a shortage and prices go up. Then we have cost push inflation. As we give people more wage increases, the cost of producing goods at that factory or business tends to raise. And the only two choices owners of companies have is either raise prices or take lower profits. Now, I think that's a common sense decision. Do I raise my prices or lower my profits? I'm a real estate investor. I saw this coming. I had about 12 of my leases expire back in February and a couple in March. I think the rest of what I have is going to come up soon. But the point is, I knew back then there's going to be cost push inflation. People have more money and they're going to have to pay more for things. And so I might as well have them pay more for rent. They've got the money to pay it because they got this extra money coming in for various reasons. We also have built-in inflation. That's, again, where the employer gives them some extra money, but then the cost of goods goes up because companies are in most cases going to raise their prices, not take a lower profit. They got shareholders to answer to. They want to make a profit to stay in business. Even the small business owner can't keep absorbing all the increases. We still have more and more companies each day offering you a discount if you pay in cash. I just had a whole house that I'm renovating, get rid of all the junk. The junk removal guy out of the area gave me a quote and he sent me an invoice for much more money. And I said, what happened? Where's this extra couple $100 coming? He goes, oh, I assumed you were paying by credit card and there's a 4% credit card fee. But if you want to send me a check through Zelle or PayPal, just knock off 4%. How many of you have made a decision to pay for with cash all of a sudden instead of using the credit card? And very simply, if this card can let me borrow money at about 1.5% and I've got the cash, then I'm actually using credit at 1.5% to pay a bill, not 4%. And if I pay that bill with a credit card that gives me a rebate or a return like my Spark card at 2%, I'm actually going to make a little bit of money by doing it that way. Not a lot, but at least I'm not losing by paying 4%. We also see, as we just maybe do a quick review in the few minutes we're together, some key takeaways about inflation. I think it's just simple common sense. I've alluded to it in some way. You know about it already. In fact, right now, as we're into this for a few moments, some of you could be totally overwhelmed. Holy cow. I didn't realize that. And some of you are underwhelmed. I knew that. Well, let's hope that we bring everything together so you get at least one good takeaway, maybe two good takeaways, but I'm sure 4 good takeaways from today. But these are the key things just to get a feel for the problem we now have that we have had for years and will have in future years. Again, if you want to see what to do, go back and look at 2004 and 2006. Go back and look at 1981 and 82. We learned a lot from that. But those who don't understand history, as Alexander Tyler says, are bound to repeat it. There's that balloon. If the Fed decides that inflation is blowing up too fast, which they have, obviously, just as if the balloon blows up too fast, it breaks before it reaches its potential. If you blow a balloon up very, very, very slow, and someone next to you blows one up very, very fast, and someone's taping that whole thing to replay it, the balloon that's being blown up fast will break and be a mess much quicker than the one that's blown up slowly. See, growth in this economy needs to be growing slowly. We have done very, very well over the last decade or more. The Fed's controlled inflation. The Fed's kept the funds rate low. Money was cheap. A lot of things happened slowly. All of a sudden, we saw this huge influx of money for many reasons, good, bad, or ugly, with nobody producing. And we're spending money on things we never thought about spending money on as we help other countries. All those things started to blow the balloon up real fast. And the Fed says we can't let it keep blowing up fast because it's going to break and we'll have a mess. So they're pumping money in to slow down. They're taking money out to slow down by pumping in investments and raising interest rates to slow that balloon down from breaking. And then their goal will be, as they do this quickly, because they want to solve it fast, then they want to make sure they don't let it down too fast, because then we create the other problems in the economy. So I think a balloon analogy is a good way to see the problems of an increasing market inflation, balloon blowing up too fast. And the other end of that is, once it's blown up and the Fed's taking action, now their job is, how do we release this eventually, and when will we get the balloon down to the size we think it should be? If you blow a balloon up and let it go, the air will go out real fast, but you'll have no idea where the balloon's going to end. But if you hold a balloon in your hand and just open it slowly, let the air tweak out real slow, even whistle, slower and slower and slower and slower till there's no more air in the balloon, it'll drop right in front of you. You know exactly where it's going. So the Fed understands, where are we going? How do we get there? We got to, first of all, get rid of this big number that's happening at a rapid pace, 8.5% inflation, worst we've had in 40 years in such a fast pace, and talk about some other things, which we will do. So 5 facts. Federal Reserve defines inflation as an increase in the price of goods and services. Inflation has a lot of reasons, but it's too many dollars chasing too few goods. And the inflation rate was only 1.4% back in the beginning of 2021. And here it is, the middle of 2022, and it's over 8.5%. Now it's a headline inflation, but the numbers are still consistent numbers. And so the federal funds rate is going to modulate inflation. And the Fed announced a massive sell-off of their billions of dollars in Treasury portfolio. They're going to make people think about, hey, I can get this kind of rate. I'll give the government money to hold on versus spending money and not cause raising prices. So somebody that might save this way might be able to buy and make some money off that Fed rate. We got to talk about the tips. A lot of changes. We also have something else popping up. I should put up a screen about the 5 facts of recession, because somebody is also talking, if this isn't done properly, we will go from inflation to recession in a different way than we've ever done before. I don't have any idea if that's true or false at this stage. It's way too early. But it's amazing, as we just start trying to solve inflation, people are talking about recession. This is why you've got to read some information to get some good information from people. But these are the costs. We can see many businesses closing down, no competitiveness. We just announced in our area that a company's been around for over 100 years in Deerfield, Illinois, Baxter Laboratories, is selling its corporate headquarters. They can't be competitive as people go back to work in a hybrid model. There's less investment because it's uncertain. Just look at the stock market in the last couple of days. I think this is the largest loss, over 1,000 points yesterday. But there are some costs of reducing inflation. One of them is higher prices until we can control some things. Because if people have money, they will spend it. So the Fed's saying, we're taking some of the money away. You're not going to have as much money to spend. And your real income falls. That's why the people who got huge wage increases last year that sounded tremendous are still way behind the 8 ball because the cost of goods rose faster than the extra amount they received in their income. And we have these processes. Something else, and this is just numbers through February, it's the most recent data I have. These are the major areas across the board. Now, again, it's different in different markets. That's why headline inflation is somewhat misleading, but still a consistent, accurate model from validity and reliability. And maybe in your market, gasoline is not as bad as home energy gas. Maybe it's worse. But we see some numbers. We see some numbers. Chicken is way changed since February of 2022 because we had that bird flu and a lot of chickens had to be destroyed. Egg prices have gone up quite a bit more than 13% in some markets. So again, these are just numbers. You got to take them with a grain of salt till you find out what they're talking about and where that was taken and all the other factors. But look at this. If you are using more of this than others, you could have some huge increases in your budget because you use a lot of peanut butter or use a lot of steak or use a lot of rental cars or whatever the case might be. So just realize you need a personal inflation index, and we'll see that in a few moments. A personal inflation index. There's the stick. Don't worry about all the things you see the president, but these are all the things we've talked about. We talked about the price of various fuel, talked about the price of food, we talked about the price of cigarettes, anything people want, transportation costs. But your personal life should be looking at a stick. How do I consume? What do I consume? How much do I spend consuming things I want? Now, it's not just food. It could be clothing. It could be changes in your purchasing power for certain goods and services. What are you spending on consumption? And what can you do to make those dollars go further? Do you watch for sales? Do you buy things that have coupons? Are you in all the rewards programs at all the stores? How has your consumption patterns changed? Because obviously, we spend a lot of money on consumption. We spend a chunk of money on taxes. That only leaves us money to either invest or build a safe account. Now, I'm never going to use the word savings much when I talk to people because that V is not for victory. A savings account is oftentimes a losing account, and inflationary times more than ever. Leaving money in a savings account is almost always a losing account because what they're paying is much less than the economy is growing, which is why the title of today's, or the banner on today's presentation, was Gold, Silver, Diamonds, Real Estate. Those are the types of things that tend to be inflation-proof, hard assets. Money is a soft asset. Gold, silver, diamonds, platinum, real estate, and even food storage if you know how to buy in quantity. And I don't mean going to a Costco. I mean looking for bargains that you can stock up on, whether it's non-perishable items or perishable items that have a long shelf life, like soup and other packaged goods. But you need a savings account, SAFE, set aside fund for emergencies. And one emergency might be when that product goes on sale. I'm not an apple juice drinker, but if I was an apple juice drinker, I would have known right away that price was one of the lowest I've ever seen. I just bought 2 half gallons. If I was an apple juice drinker, that stuff has a long shelf life, or long enough shelf life to buy more than 2. And then once I realize I've got enough money set aside just in case, then I can take some money to invest. Once again, though, what are you investing in? If you're investing in assets that aren't growing as fast as inflation, you're losing. So gold, silver, diamonds, real estate tend to be assets that most people want to buy because they move along at a faster pace than inflation in many cases. Diamond prices are up huge over year to year, sometimes up to 40%. We see hard assets like cars becoming very valuable. We've seen hard assets like silver, gold. A lot of those hard assets are what people hold in times of inflation. In fact, that's the key. Look at your plan for the next 18 months. How much of your plan is going to be hard assets? How much is going to be soft assets, very liquid assets? The difference will determine how well you are when 2024 rolls around. But that all takes that K word, knowledge. Knowledge is not power. I share a lot of knowledge. Everybody, every day in this whole group that Brian Culhane put together, every day we got something for everybody every week. Powerful people. I'm just privileged to be a part of this weekly process available to everybody. But we all share a lot of knowledge in our own way. A lot of you listen to all our knowledge. Knowledge is not power in Wayne's world. Knowledge is only potential power. It does not become power until you use it. If you don't buy any gold, silver, diamonds, or real estate this year, you'll see why you didn't have the same outcome by 2024, or maybe even late 2023. If you didn't understand the power of tips as a possible treasury security to use, if you didn't want to take a lot of risk, then you won't know how to inflation-proof yourself with a treasury investment. So, STICK, savings, taxes, investing, consumption, and knowledge. Grab that stick and take a good grip on that stick and look at all of those in your life, and you should see something that you can be doing to make sure that stick never leaves you. Now, obviously, I'm not a lottery player. I am a person that says the odds don't look good to me. I know I can't win because I don't play. I accept that fact. But if I just put that money away, there's some magic numbers. Just $20 a week with a little bit of return on your investment. That's $1,000. In 2 years, a couple thousand. In 3 years, my gosh, just been out playing the lottery. But see, we have an issue of building wealth, which we covered once before in my 5 reasons why people don't build wealth. And that is, many of us can't delay instant gratification. Oh, it's only $2. It's only $5. Maybe I'll win. That's that whole mindset. We buy things on impulse because we can't delay instant gratification. That's why there's end aisle displays. That's why at the grocery checkout lane, there's all kinds of snack items and fun items that the kids can pick or use to stand with. I guess I should get some of this. A lot of money is spent while you're unloading your groceries, unless you're disciplined enough to not buy those candy bars or that gum or those breath mints or whatever else they are selling on that place. There's big money per square foot at grocery store checkout lanes. Sometimes some of their biggest profits come from what you buy as you check out. Again, try to delay instant gratification. And that's why real estate as a long-term investment allows that to happen. But over time, and that's the key, things happen. Also realize that the best investments during inflation, and I think commodities are risky. You've got to know what you're doing, just like day traders are risky people, but they have to know what they're doing. You can learn that. But more importantly, hard assets, gold, silver, platinum, and other metals are a great hedge. But real estate that helps you profit from both rising rent payments and appreciation as the property increases in value. So please, to become a Wayniac, you buy at least 2 income properties a year. At least 2. Take the tax benefits, build your exit strategy, and we're going to talk more about that in future sessions. Diamonds. I had a diamond investment business for years before I came into real estate, but only GIA certified diamonds, Gemological Institute of America, not the EGL lab, not somebody's thing they make up at their store, GIA certified diamonds. An appraisal from the Gemological Institute of America, or you pack up your diamond ring and send it to them, or your diamonds, for them to send you the grading back. And then food storage has its place. And again, I go back to some people's religious beliefs create food storage. The Mormons are probably the best example. Some of the ways Mormons build food storage facilities in their homes, because they believe in 1 year of food storage, many of them, it looks like a small grocery store. The shelves are at an angle, so the oldest stuff is used first, and the newest stuff is loaded up in the back. And they buy in quantity, whether it's the soups or the canned goods or whatever else they feel they can use, the paper products, etc. So here's the key. Headline inflation, you're going to hear about it. Core inflation, better indicator of what's really happening, but it could be different for you. The key is your personal inflation rate. If you don't drive, as I say, in a warm climate, then oil prices don't matter. If you're single and don't eat much food, then food prices aren't a big deal. But if you are, again, these people driving to and from work to go the 29 miles like I did, and some go further, not only is their time use being very costly, their cost of getting to and from, then they got to park their cars, and it could be very expensive. Then they've got some other issues that have to be done. Maybe oil changes are done more often because they change every 3,000 miles and are driving 80, 90 miles a day. So inflation needs to look at all the items you normally use and keep a little log. What did we pay last for this, that, these, or those? And boy, talk about a confusing world, trying to figure out what's the best value in paper towels. Mega rolls, super mega rolls, large mega rolls, no mega rolls, just basic rolls. I got some toilet paper doesn't fit in some of my toilet paper holders that's so big. It's called a mega roll. Bought it by mistake because it looked like a good deal. I can't use it in all the bathrooms. Doesn't fit in a couple until I use some of it, and then I can install it. So what's your personal inflation rate? A good challenge to look at between now and next week. A good challenge to look at. Again, your CPI, your personal consumer and consumption index versus the CPI. And because the CPI is headline inflation, it's probably going to look worse than yours overall. Very few exceptions. So go back and just review some headline inflation, some core inflation, and then your personal inflation, and see why I think that is what is more important. What's your personal consumption pattern? Also, I mentioned tips earlier today. Again, government issues a lot of investments to a lot of people. One of them are tips. And TIP is an acronym for Treasury Inflation-Proof Securities. Treasury Inflation-Proof Securities. Buying these tips versus other offers from the Fed, because there'll be offers now because they're trying to take money out of the system by enticing you. But you'll also realize something. I happen to be on the finance committee for our board of realtors. Our investor company came online and expressed to us why they're looking at short-term CDs, because we have to have safe investments because we're a fiduciary for our members' funds. And what they simply said was, we're looking at 7-day CDs. In some cases, even less than 7 days, 15-day CDs. They don't even want to take a monthly CD right now because rates are changing, and we're investing a lot of the cash that we need to be conservative as a fiduciary for our 4,000 members of the board. And so they're looking at very, very, very short-term brokered CDs as an investment strategy that's safe and meets our criteria for risk as a board of realtors. Short term. So the year, the 2, the 3, the 5, wow. You would have to be a head of lettuce, in my mind personally, to buy a 5-year CD. And just so you know, head of lettuce is my code word for idiots so I don't get sued. It's a vegetable. But the bottom line is rates between now and 5 years could double or triple in terms of what they're offering today. So one option, Treasury inflation-proof securities. Tips. They're basically going to pretty much guarantee that you will be able to get a 5 or 10 or 20-year tip, and it pays you the inflation-adjusted principal or the original principal, whichever is greater, so you can't lose. The longer you take it for, you might not win as much, but that's the strategy you talk to your investment advisor on, your accountant on, your legal counsel on. The bottom line is, the worst case scenario, it's like playing the ATM machine in Vegas. You can't lose, but you don't win. So if you think of the ATM machine in Vegas instead of a slot machine, that's what a tip is to me. I might make money, but I'm never going to lose money. I always break. The worst case scenario is I break even. They pay a fixed rate of interest, adjusted because of inflation. So in the short term, they make a lot of sense. So again, if you want the investment aspect of the federal government, which you have a right to do, risk equals reward, at least look at tips as the best option as the Fed is trying to get you to take your money out of the system by buying up their securities, because that's exactly what they're offering. They just announced that they're going to really shrink their portfolio of billions of dollars by offering in the open market. In addition to the rate increases every six weeks. So once again, 14th or 15th of June, roughly, should be the next Fed meeting. Put a reminder in your calendar, see what the word is a week before. What are we anticipating? Right now, Chairman Powell says it might be another 0.5%. And I don't think, as far as I can remember, I've never seen 2 0.5% increases back to back. Never. So one of the best hedges against inflation in Wayne's world and my life is being a real estate investor. I practice what I preach. I buy at least 2 properties a year. I will say at this stage of my life, I'm starting to get rid of a lot, and I don't always follow that strategy anymore. Probably for the last 4 or 5 years, I've been slowly 1031 exchanging and doing some other things with my investments so I can enjoy all the passive income that I have been able to make available, which allows me to have less and less earned income. Money I work for, nice, versus money that works for me, really nice. See? So your home is still going to be a good investment. I have no problem with people buying a home and taking out the largest mortgages possible. I would have loved to have been a veteran and be able to leave the service and be able to buy a 4-unit with no money down. Live in one, rent the other 3, and start my investment portfolio. It's the least we can do for the veterans, but what an opportunity. And I honestly feel in many markets, there are literally thousands of veterans who have not taken advantage of that benefit, whether it's a duplex, triplex, or a quad. No money down, as long as they live in one of the units. So the home is a great investment, but if you let the equity just sit there and not use it, it gets stale. Money has to work. There's actually something called the velocity of money, if you take a macroeconomics course, to understand how fast the money moves around, not only in the economy, but in your own personal life. Are you using your money over and over and over? See, when I get my money, I'm not just going to hold this money. I'm going to do something with it. I know it's costing me about 1.3% based on my tax bracket or less. So if I can get anything above 1.3 with somebody else's money, I'm going to do it. In addition, we know that real estate investments, i.e. apartments, small commercial, whatever you feel comfortable with, is going to increase your income and grow over value. That's why we love to see the long-term appreciation of inflation. But not just the long-term appreciation, all the other items that come with inflation as it compares to any other asset to use in times of inflation. Real estate investing is by far the most comprehensive way to be in a marketplace like now, or be in a marketplace when we have a recession, because it doesn't make a difference when you have real estate. If you don't have to sell it right away, it's a long-term appreciation. Your exit strategy as a realtor, over the long term, you've reaped 5 major benefits that no other investment can do in the same way. And that's what I'd like to move forward and talk about right now on. But before I do, just a quick reminder, you should know the rule of 72s. That's the one they teach in most classes in grade school, high school, college, that money doubles or investments double by dividing the rate of return or the inflation rate into 72. So here we are. We're talking 8% inflation, 9% inflation. That means if that continues, and God, I hope it doesn't, but if it did, everything would double. Things would cost twice as much in 9 or 8 years. So let's take it one step further. Let's see if we can accelerate this process, because I like to move things fast. The rule of 114s just tells me by dividing that same interest rate, whether it's 9% or 8% or whatever, or the rate of inflation into 114, it's how fast things will triple in value. So if we have an 8% inflation rate into 114, we can see how soon the investment will triple. Triple. I get so excited on these, I get confused. But the one I really love is the 144, how fast your investment quadruples. And here's the beauty of real estate. You don't have to use your own money, and sometimes none of your own money, because you buy with no money down or a couple of a second or third mortgages. Now the investment grows without using any of your money. So 72s tells you how fast things double. Rule of 114s, how fast they triple. Rule 144, how fast quadruples. That $80,000 condo you bought to fix up. If inflation is just 6%, 6 and 244. In less than 30 years, that $80,000 condo is worth $320,000. If you just borrowed money, by that time you have an asset you bought for 80 that's been totally paid for. And guess what? Since it's an income property, guess who paid for it? The tenants. And if you put very little or no money down on it, which is a good strategy, this is like, wow, why am I not doing this, people? You may want to run out, and by the time we meet next week, send me an email or a text message or a chat that says, I just bought something. I can't believe it, because I see myself doing this on a regular basis. So what's my goal? My goal was always to create enough passive income that would exceed and continue to get greater than my active income. And I'm happy to say that I reached that magic number many years ago. Over 30 years ago, I reached a point where my passive income started to be bigger than my active income. And it just keeps getting bigger and bigger and bigger. To today, looking at me and looking at my life, I'm realizing most of what I do is because I love doing it, like being at the NAREP convention yesterday, to earn some active income. But the real fun is watching the other investments bring me passive income. My royalties from books, my rents, money that works for me versus money that I work for. Again, I had to drive almost 3 hours, about an hour and a half each way. Well, it's 2.5. Coming home was less. But 2.5 hours of my time yesterday was just sitting in a car in traffic and rain, because it was part of me trading some time for some money. Versus today, I'm talking to you for an hour. and I'm going to enjoy myself. I got things to do that I want to do, but wow, my investments are still working. Not to impress you, but to impress upon you the power of passive income, and how each year you should see how much more my passive income is growing and how much less active income I'm earning. And if you want to work a lot, that's your choice. But can your passive income always be greater than your active income? That, my friends, is what Wayne's World of Wealth Building is all about. To consistently, continuously have my passive income be greater than my active income. And if you want to work more, just get more passive income too. And pretty soon you'll start to realize, whoa, I got enough passive income. Maybe I can slide back and get some financial freedom, which gives me some time freedom, which gives me some life freedom. Just being in real estate, you all know the benefit of time freedom, the flexibility you have over the hourly worker, the person that punches in and punches out, that has a schedule every single day, same day, over and over, every day, 5 days a week or more. And then you've got your portfolio. You might get some tips. Maybe you want to play the stock market. But again, that's a different kind of risk. And it may not be a wealth building risk. Right now, somebody who needs money today took a beating in the last couple of days. Maybe a quick summary. Take a moment. I think that will give you the best perspective or the best analysis. Earned income, you can make it. You just got some people doing second, third jobs to earn some money quickly. The drawback, you're trading your time versus the passive income. You got tax benefits. Again, you as a realtor, as a real estate professional, investing in real estate and owning your own business have so many tax benefits. It's unbelievable. Because you have unlimited passive losses from your real estate investments against your income. That adds up real fast as you keep buying more properties. You can pretty much write everything off you use in your business. But the only thing you can't write off are your clothes unless they're embroidered with your company logos on. If you don't mind wearing your company logo on all your clothes, then you're writing off your clothes. Or if you keep a wardrobe that you use only for real estate at the real estate office where you go in and change clothes, that can be used as a benefit. I may spend some time, if you'd like, talking about tax benefits because as a real estate investor, I get audited quite a bit. And as a real estate agent, I get audited quite a bit. And my theory on that is it doesn't bother me. I do not do anything that would be evading taxes, but I will do everything I can to avoid taxes. And so my theory is the only way I'll know if I paid the least amount of taxes is to be audited. So audits don't bother me. I think they should be done. I'm happy to have my stuff done. If I make a mistake, I'll take care of it. But sometimes I find out things I should have done and they tell me I should have done something different and I make better money. I never know. The point is passive versus earned. And again, capital gains from other investments. You're not working for the stocks and the bonds and the commodities you buy. There could be some tax benefits. Some people have municipal bonds and interest tax-free bonds. So you've got some options there. But I'm looking more at real estate. I'm biased. I'm a real estate agent. I put all my eggs in one basket. Some are condos, some are single families, some are 2 units, but they're housing. A lot of what I love to do is to take advantage of the tax laws, and very few other investments offer me the benefits, which is what I'd like to close with as we finish this. You've seen this in many places. It started with Dave Delgado, Tom Vu, several people out there, Carlton Sheets, and now it's most recently been attributed to the efforts of Bob Kiyosaki and his wife. The fact that you want passive income. Now, many of you started with a job and you had no leverage. You had to go to work, punch in and punch out and get paid. You want more money, you got to work more hours. Then you finally said, I'm going to own my job. I'm going to start making money in my own way, but I still changed some time. Then you decided to become a business owner, maybe hire some assistants and let them work for you. But then eventually, hopefully, no matter which one of those you are, are you going to be an investor too? So there are many people who work a full day, many in the trades. As I talk to them, they have a lot of real estate. I met a gentleman at a grocery store yesterday. He did some work for me at least 15 years ago. I said, Gary, wow. He said, you remember that? I said, yes, I do. You do good work. You still in this? Well, I'm flipping houses now. Didn't take me long to realize what he realized. Hardworking as a contractor, as he's 15 years older, he's making more money with less stress, less wear and tear on his body by flipping houses. He's got a team that works. He's like the general contractor. Now his life is an investor from a self-employed person. But many people are working and investing. In Chicago, I have a lot of firefighters that are very big real estate investors. A lot of firefighters, many towns. Firefighters love real estate as an investment, as a group of people. So be understandable the power of no matter what method. Most of you are self-employed and or business owners. In fact, way back when, probably almost 100 years ago, Andrew Carnegie wrote a book that still makes sense. The majority of millionaires in this country own businesses and own real estate. So things are looking up, but it also means that the things that cost more are going up too. Taxes are higher. Your bills have increased for food, for clothing, for transportation. And inflation is outpacing some of the pay raises people got. That's the killer. Inflation, too many dollars chasing too few goods, is the killer. But the more you know about the past, the better you are prepared for the future. That's a Teddy Roosevelt. Alexander Tyler said it this way: those who don't understand history are bound to repeat it. So we did quite a few things. We looked at the Fed. We looked at the changes. This is something I really feel you should block out 15 to 20 minutes a day, maybe when you get up, maybe before you go to bed. What's going on in the marketplace? What opportunities are available to me to become a winner in this inflation? So I'm practicing winflation versus some other type of inflation that is not helping me win. You want to learn to be the transferee of wealth during this time. The transferors lose wealth. The transferees receive the wealth. As you reflect on what's happened so far over a third of the year, have you been the transferor of wealth or the transferee of wealth? That's really the question you have to ask yourself as you go through all of this. With that said, I hope we've given you some tips, some techniques, some TNT, some dynamite to become a winner during this inflationary period of time. Enjoy your weekend. I will see you again next Friday for another session of the World of Wealth in Wayne's World. Have a wonderful day.